But let's talk about banks in particular. And while talking about banks, let's talk about Federal Bank because they've come out with their numbers. Yesterday, post of market hours, the stock is trading higher by about 7% right now. We have Mr. Venkatraman Venkateswaran, who is the Group President and the CFO of the bank, joining us on the show right now. A very good morning to you, sir. Thank you so much for joining us on ET Now. And a strong quarter actually to begin with for at least Mr. Manian. So let's begin with the NIMs. Although it went down by about 4 basis points on a quarter-on-quarter basis, we believe that there was an impact of a penal interest. Can you quantify the impact for the quarter? And excluding that, if you could tell us what would be your NIMs like?
See, like you said, there has been an impact of the change between penal interest and penal charges in this quarter. On a like-for-like basis, if the change had not happened, our NIMs has actually improved. It's moved from 3.16 to 3.19, about 3 bps improvement. But due to the change, you're seeing the reported NIMs is 3.12. Having said that, we see part of the benefit in the fee income line where the penal charges is reflected this quarter.
Right. Mr. Venkateswaran, other than that, your fee income has also increased. Is it a one-off event or shall we expect fee income to grow from these levels from here on?
Absolutely. In fact, if you've seen our fee income growth this quarter, the core fee income as a percentage of assets has moved up to 0.95% from about 0.84 in the previous quarter. There aren't any one-offs in this, in the core fee income. This is driven largely by the growth in parabanking, commissions, forex income across different lines. And as we had mentioned earlier in the last earnings call, we have onboarded 2 new life insurance partners, Tata AIA in June and Balik Bajaj Allianz in July. So we are starting to see traction of 2 new partners coming in. So the income from that is also helping us grow this. And to your question about whether we'll be able to sustain these growth levels, we are reasonably confident that fee income growth will continue to be above the 25% CAGR, which you have seen over the last 8-9 quarters.
Right, let's talk about the advances growth. It's been strong for Federal Bank in the quarter gone by, but deposit growth, that was a bit softer for the quarter. Do you think that this can be a constraint for your loan growth going ahead? And also, can we expect to see the bank growing at 18% levels going ahead?
I think let's split this into 2 parts. One is the deposit growth in Q2 and then advances growth outlook or how we expect that to move. As far as we are concerned, the growth outlook, credit growth outlook, we are reasonably confident of maintaining around the high teens, say around the 18% mark. And we see reasonably good credit quality growth. One of the main advantages or the strength of Federal Bank is the pristine asset quality and credit cost being maintained at the levels which are probably the best in class in the industry. So we will continue to focus on that. What we will do to improve the CD ratio, which is one of your points, is to make sure that the deposits start growing in line with or closer to the advances growth, which is what we have been demonstrating over the last several quarters. The Q1 to Q2 was where we saw, the Q2 growth is where we saw a sort of dip. That was primarily because we took a call to reduce certain high-value deposits and the wholesale deposits. And because it comes at a price, as you know, we can get deposits at a cost. We also want to make sure that we maintain the cost of deposits within manageable levels. Having said that, if you see the growth in Q2, you split between CASA and deposits. CASA has grown very well, probably one amongst the best in the industry, 4% quarter-on-quarter CASA growth. And the other important factor to note is within that, even the NR-SA has grown quite well, almost 3.8% in this quarter. So what I'm trying to say is it's a combination of certain factors on conscious call taken to reduce certain high-value deposits, at the same time growing our CASA, including growing the NR deposits in SA book.
Right. So, although still a draft circular, but given that some impact may come on the runoff factor as well, do you find banks' LCR at comfortable levels?
Comfortable is not the right word because if you have seen again on LCR, we have actually improved quarter on quarter from 112 to 115 is the average LCR in Q2. Again, that was because of the measures we have taken. It's about the change in mix of deposits, more of retail, callable, non-callable, CASA growth, tenor of the deposits. A combination of several factors which we worked on has helped us, and we'll continue on that trajectory to make sure that the LCR growth is sustained and improves as we go along. On the circular which has come, yeah, we'll have to wait to see the final. These are draft guidelines, what comes out. But having said that, our focus on growing the deposits and CASA will help us ensure that we are meeting the revised guidelines as well as and when it comes out.
Right. Let's talk about the asset quality because that's one factor that has been actually holding up well for Federal Bank. But given there's been a stress rising, especially in the retail unsecured book, do you see any early signs of stress due to over-leveraging of retailers in your book in particular?
See, if you look at our book, the unsecured retail continues to be less than 5% of the overall book. In fact, for this quarter, it's about 4.5, 4.6%. And split that between cards, PL, and MFI. Whilst there is some stress which you see in some of the segments in the market industry-wide, we have seen some. But the advantage for us, let's say about MFI, we operate in about 22 states. So the risk is diversified. And we are not in some of the states where the stress factors or the slippages has been high. Except for Chhattisgarh, where we saw some elevated slippages. Most of our exposure in MFI, like 2/3 in southern states, is holding up quite well. And our overall slippages for the bank as well has been the best ever in the last 15 quarters, 0.75. It's come down from Q1. So I think it's the same philosophy which we operate in, moderate risk appetite, consistency, and, well-managed growth. We are, as you know, we are not a bank which is going to be reckless in growing one particular segment for a short-term gain and then seeing the impact of it in the subsequent quarters. So we're quite calibrated in terms of how we grow the unsecured as well.
Right. So with the new management in force, any near-term agendas and the book that you would like to share?
Now, like Mr. Manian mentioned yesterday in the earnings call, he's just come in, spent about in the role as MD for a little over a month, 7 weeks in the bank. He's taking his time to understand how we operate. He's doing his so-called listening tours across the country, meeting people across levels. That will continue, and the plan is, every year in last quarter we do a strategy refresh with the board. So somewhere around mid-December we'll do that this year. Post that, we'll firm up what is the next course of action, how we grow from the base which is there currently, and what are the new initiatives. I'm sure we will come back to you, after the Q3 results and update in terms of how we are going to position the bank for the next stage of growth.
All right, let's talk about your ROAs because they have been actually in good shape for the bank. In fact, we've seen an improvement on that particular front as well. But in the near term, are you seeing any change in the momentum? Do you expect the momentum to continue going ahead? And also, if I could add to that, what are the levers for your ROA?
No, ROA, there are several levers which work on it. One is obviously the NIM, then you have the credit cost impact, fee income, the cost, and the slippages. So you have several levers which work to make the ROA. So it's not just one. So we are reasonably confident, like we said in the call yesterday, that we'll continue to maintain the ROA at the current levels, around 1.28. But we are again mindful of the headwinds. We have to be careful, be aware of what's the environment we are operating in, and there may be some short-term corrections which we need to make. But at this stage, as we see, we are going to be maintaining ROA at the current levels.